Hey everybody, how you doing? It is Thursday, January 2nd, 2025. So we are into the new year. And as I've been saying, expect a wild ride this year. We got Trump coming in 18 days. Got to see what the new policies are going to be right now. And earlier this week, even late last week, I said that we would see the market, we would see S&P and NASDAQ rally to new highs. That call is definitely looks like to be on hold right now, although yesterday was a big positive flow day. I'm sorry, Tuesday was a big positive flow day, and so was today, because first of the month payments, they were split up between those 2 days. So, what's going on here right now in the very short term, and it may play out to be correct, but I'm just saying, like, in the very short term right now, and that means, coming into the new year, there's a view that 2025 is going to be, the economy is going to have to deal with stagflation. Okay, that's anyway what I see from all the commentary and the forecasts. It's like the Trump policies are going to lead to stagflation. Now, there's no evidence of that. It's just a view. It's a view that people saying based on tariffs, maybe based on some spending cuts from the Doge thing. I keep telling you guys, we got to wait to see what actually gets passed. But right now, and this is not atypical. I mean, this is actually normal at the beginning of the start of a new year. You got asset managers who have an outlook for the year, and a lot of this gets snowballed into people start to put out a forecast, or Wall Street puts out a forecast, and everybody kind of coattails onto that, and it's like, oh yeah, there's going to be stagflation. We better prepare for that. We better align our portfolio for that. Look, I could give you an example. I mean, in 2022, when everybody knew that the Fed was going to raise interest rates, was going to start raising interest rates, because the Fed signaled that they were going to start raising interest rates, the portfolio realignment was to sell stocks, okay? And we know what happened. I mean, basically, like, it was a 6 or 7 month period up until October 2022, when everybody was saying there's going to be a recession, they're raising interest rates, blah, blah, blah. I said that wasn't going to happen. I said that, that was an overreaction. That was also a reaction based on a lack of understanding. Once again, this monetarist view, which is the single variable view. They only look at the liability side. They never look at the asset side. And I said that the rate hikes were going to result in major increase in interest income transfers. It's going to be positive for the economy. It's going to be positive for the stock market. But until we hit that point, that inflection point, if you go back and if you listen to my videos at that time, I kept talking about we're going to hit an inflection point where those net transfers are going to offset whatever the discounting effect is from higher rates to financial assets. They use this formula, discounted cash flow. I happen to think that that's a flawed formula. I mean, it doesn't take into account exactly what, I mean, it looks at the liability side, basically, of the balance sheet. And it doesn't look at the asset side, these flows that I talk about. Anyway, that's a whole other discussion. But that's exactly what happened. I mean, everybody positioned for a recession. And remember, we came into 2023, that recession call was universal. They all got bearish. And you see what happened to the stock market. It went to new all-time highs, like, over and over and over again. I said that was going to happen. We're seeing the same kind of phenomenon right now, where they're saying, okay, there's going to be stagflation. we better start selling stocks, we better start raising cash, it's going to be better. There's no evidence of that right now. There's no evidence of that right now. Just like there was no evidence that the rate hikes in 2022 were going to cause a recession. As a matter of fact, the evidence was entirely the opposite. That it basically ended up to be a major, major fiscal stimulus because of those interest income transfers. So I'm kind of on the sidelines right now because I don't know what the policies are actually going to be when they, the ones that actually get passed. I do happen to think if you were going to like pin me down on this, one thing that does bother me a little bit is these fiscal hawks in the House. They're Republicans. There are about 30 of them. And we got a little bit of a tell on this when, the House was working on that spending bill that passed, a week ago or something like that. And Trump wanted an extension or a suspension of the debt ceiling. And it was those 30 Republican House members that said, no, we're not going to agree to that. So, and I don't know if they're, if Elon Musk is quietly kind of, egging those guys on or whatever. He's a fiscal hawk. But to me, that was like a little bit of a bad sign, at least fiscally. All right. It doesn't mean it's going to work out that way. Trump may get his way when he eventually assumes office. We got to see what's going to happen. So right now, you kind of see how this is playing out in the markets with the stagflation. They're selling every rally in stocks. Bonds are kind of holding in there. It looks like bonds want to rally, but the deflation part of stagflation is still keeping pressure on the bond market. They were buying gold today. They were buying oil. By the way, the oil report today, when I took a look at it, you had huge increases in gasoline and distillate inventories. Okay, so product inventories are building up. Demand fell off sharply, especially with distillate. You had, exports held in there, but it wasn't very positive on the demand side, and it wasn't very positive on product inventory. So, crude traded up to 73 on WTI. I don't think that's going to hold. The other thing is you're seeing natural gas pop up on the forecast for really, really cold weather on the east coast of the United States. And also, I think Ukraine was shutting down Russian gas transiting to Germany or somewhere in Europe. So that pushed up natural gas prices. But if you look at natural gas storage, it's ample. Okay, so I think that's going to come down too. So again, I don't, the whole stagflation thing, I need to see evidence. Right now, the flows are really strong. We went through a tax strain in December. About 2/3 of that has been already recovered. All right. And I suspect it's more than 2/3 because I don't have the data from today's transfers. I'll get that in tomorrow's Treasury statement. And then in February, we get another quarterly interest payment, although there is a tax strain on January 15th, I think. So right now, the flows are not negative at all. They're rising. They're accelerating over last year. That's positive for the economy. The economy is growing. This is not a COVID shutdown situation where you have high levels of spending and an economy that's shut down, which cannot produce the output. GDP growth is over 3%. So the output is there to meet the spending. And the other thing that you have to take into account, at least on the inflation side, is China. China's economy is slowing down. It's struggling. I said, a month or so ago when everybody was cheering the China so-called stimulus, I said that's not a stimulus. That's, again, monetary operations. China has completely bought into Western monetarism. That's what they go by now. And, China is very heavily dependent on growing its economy through exports, which means it literally seeds or it relies on external demand. It's a crazy economic system. I mean, you're literally seeding your economy, handing your economy over to external demand, which you have no control over other than, if you want to maintain volume of exports, you got to devalue your currency or keep the wages low. So I see China basically exporting deflation in the world. I don't see them as an element or a source of inflation. So this whole stagflation argument, maybe we're going to get some of the stag in the stagflation. I don't see the inflation part. I just don't. And if we get the stag, if we get the slowdown, then the place to be, in my opinion, is treasuries. I mean, the Fed is going to pivot once again. It's going to say, you know what? We got to start cutting rates some more. And I think that's one area of the financial markets where very few people are looking at right now. I mean, they're still very, very nervous about inflation, and rates are too high, and they're going to come down. So I'm kind of on the sidelines right now. I'm using these pullbacks to selectively add to some of my stock positions. But I'm waiting to see. We have 18 days. Trump comes in. We'll get the first indications of what he's planning to do. Maybe some things by executive order. The new Congress. And we'll have a better idea. I always say, the beauty of this is they tell you what they're going to do. Okay? There's no need to guess. Whether it comes to the Fed, whether it comes to fiscal policy, they tell you what they're going to do. And the other beauty of it is that, the 99% of them, the 99.9% of the rest of them out there don't understand the real impact of monetary policy and fiscal policy. That's where having an understanding of MMT, puts us at an advantage over the rest of them who are just they get it all backwards. Anyway, that's it for today, folks. And here we go, the start of the new year. Please like and subscribe, and I'll see you tomorrow. Bye.